welcome to Cafe Mutual YouTube channel. Friends, as we all know that debt funds have not performing well over the last 1, 3 and 5 years. In fact, most categories of debt funds have given less than inflation returns. However, if experts have to be believed, RBI will not increase the rate any further, and debt funds will make a strong comeback from here. So to discuss this more in details, today we have with us Anju Chhajer, senior fund manager, Nippon India Mutual Fund. Anju has over 25 years of experience in treasury and fixed income industry. So without wasting time, let's welcome Anju. Good evening, Anju.
Good evening.
Anju, my first question to you is that there is uncertainties around interest rate, inflation, and other global events continue to exist. So in such a scenario, what is your near-term outlook on debt funds?
Uncertainties there are. I will not say because all our central bankers, after hiking rates over the past 1 year, have now become data dependent. Earlier, we had some certainty that okay, rates will go up and they will be, hence, it was easier to price in. Now, the uncertainty of whether further rate hike will come or not, whether another 25 basis or another 50 basis, that uncertainty is there. That has become because central bankers have become data dependent. they they will act depending on how the data pans out. Like yesterday all itself, Federal Reserve chairman again said, repeated the same thing, that we are data dependent. Depending on how the inflation numbers come in, how NFP data come in, we will be deciding on whether to hike by 25 or 50 broadly.
Mm-hmm.
So the uncertainty in US also boils down to India also. Otherwise, if you look at Indian data, Indian fiscal FD, Indian current account deficit, if you see the overall macro in India and how the inflation outlook for next year, as per RBI also, the projection is up 5.3% for next financial year. Inflation will be there. Considering that 6.5% repo uh, is done and dusted. It seems we were very sure before, if you one would say 2 months back, that 6.5 could be the peak of a repo rate hike in India. But if you look at because of US, uncertainties have come in, and those percolate to Indian economy and Indian, because we are dependent at the end of the day, dependent and interlinked with the US and international economies. So considering that, there is a further build-up of 25 basis rate hike may happen in the month of April. But again, in this data also, this is also data dependent. So in these uncertain environments, market always prices in the uncertainty. So if you look at market levels, the pricing in has happened. If you look at a 3-year curve, it is at 90, 790. If you look at GSEC curve, it is around 45-50 range. So most of the uncertainties are currently pricing. Even if there is a rate hike, if we one would say that these that has been priced in the current market levels. So taking that cue from the fact that we have already priced in, these are good levels to invest in. And we always know whenever we invest in uncertain environment, then only one is able to make more money than if we have certainty, then naturally the amount, the additional capital gains won't be available. So these are good times to invest. If you absolute level wise also, if the curve is around 8%, historically we have seen debt funds always perform well, yeah, when levels are here.
Okay. So, Anju, bearing credit risk funds, I mean, all other debt funds have given less than inflation return in 1, 3 and 5 year time horizon. Hence, many distributors have now been shifting their assets to P2P lending, NCDs, and invoice discounting. So, in such a scenario, why do you think that debt fund still deserves a place in clients' portfolio?
I think this is an unfair comparison only. The kind of risk you have in P2P and triple discounting is not comparable to mutual funds, which are fully regulated, fully transparent. You have regular portfolios available. The kind of credit risk one takes when they are doing P2P and is, I would say, the risk is more than equity when you are investing in equity. So I would not compare the two. If the investor is ready to take those risks, for whatever additional returns they are getting. It is at their own wish, and they are always welcome to do that.
Mhm.
But debt mutual funds, the kind of risk we take, and the new regulation, recent regulations, if we see in which SEBI has brought in with regard to minimum allocation to sovereign component. So debt fund will always continue to be in favor. And if you are a long-term investor, if you're investing for more than 3 years, you get tax benefits also, which is indexation plus long-term capital gain. That adds value to your portfolio too. So it is at your risk when you are doing those assets which are not very highly regulated, and the risks are not yet discovered.
Mhm. Okay. So, Anju, while short-term funds like money market funds and liquid funds are good for cash flow management and creating an emergency corpus, but what are the other goals that can be fulfilled through these funds?
As you rightly said, emergency fund is a one should park in money market and liquid fund. But more than that, these funds should be used to for STPs, for equity investment. This is a very important thing. You can use this to park your funds here and wait for opportunities for markets to be at levels you may want to take a call from that perspective. From business perspective, who maintain large money in current account, they should, if they are able to manage better cash flows, they are, for them it would be a good opportunity to invest in these funds and redeem at a 1 day's notice. So a lot of these, from goal-based long-term investment perspective, naturally these are not funds
Mm.
for which one should be looking at. These are products for short-term parking, for say 3 to 6 months investment perspective. The money which you don't know, which you are not wanting to commit to
Mm.
any other investments, and waiting for, or you may have and which you want to park, and FD also, because if you want to park in FD also, there is a risk, there is a fixed period for which you have to invest. Here you don't have that, and you can redeem at any point of time, and that's a overnight, as we all know, it's a 1 day's notice. Today if you redeem before 3 o'clock, you will get money tomorrow morning 9 o'clock in the on your bank account, which is a very good investment opportunity, and very high liquidity that we provide through these products with least of interest rate risk.
Okay. So, Anju, we have seen that many MFDs simply look at recent performance to select short-term funds. They believe that these categories of funds have similar structure. In such a scenario, why do you think that MFDs should evaluate these funds in details? And what are the three things that they should keep in mind to shortlist these funds?
I agree. Performance is very important part of the methodology, reason for which for particular product will be chosen. But from a risk reward perspective, one should look at the overall maturity for any fund. Not only for these funds, for any fund comparison, we have to see three things. One, how the portfolio is managed by the fund manager, the fund manager's management strategy.
Mm.
Second, the credit profile of the fund, which which is very important for understanding how the returns are coming from, where the returns end up.
Mm.
And last not but not least, the duration of the product, the duration range in which these products are run. Say for example, money market fund,
Mm.
I would say industry wide there are various money market funds, and most of the money market funds, if you look at the maturity, they range from 100 to 300 days.
Mm.
They can jump from anywhere to anywhere. From products like ours, we have a constraint, we have put in an internal constraint,
Mm.
because we want to present money market fund as a liquid plus fund type. So where you will get better than liquid, and the risk will also be a little higher than liquid, but good returns. So we run a portfolio of 160 to 160 odd days, or and from duration, higher duration perspective. So one has to look at the investment philosophy and profile of the fund, not only from A1 plus short-term rating perspective, the long-term rating of all the instruments should be tracked by the MFD to understand how the performance has coming in each of the funds.
Anju, one last question. Nippon India Money Market Fund and Nippon India Liquid Funds have performed well and both of the funds are among the top funds in their respective categories. So, what are the three things that has contributed to this?
One thing is discipline.
Mm,
We have our internal fund casing rules, which we follow very strictly and in a disciplined manner. The products we don't go we take 0-1 calls in these funds. These are funds where carry is very important.
mm,
Focus is on carry,
mm,
but maintaining a very good asset quality. These are the things which we do. So overall, one word to explain why the performance has come is discipline
mm.
and internal risk management to guidelines which we have put in place that help us to outperform the market.
Okay. Can you elaborate the internal risk management profit process of the Nippon India Mutual Fund?
Say for example, I'll tell you, for liquid fund
Mm,
we have to have 60% of the portfolio in AAA component
mm,
or sovereign component,
mm,
but not more than 40% can be non AAA. Among the non AAA, our AAA also, there is 75% of the portfolio should be good quality triple all AAA and AA plus bank CDs and all. So
mm,
only 25% of the portfolio can be go in corporate CPs, which
mm,
is non triple M. That is one part of it.
mm,
Then there is a maximum maturity that I can go for.
mm,
That is 70 days.
mm,
Similarly, we have per issuer limits. We
mm,
cannot have more than 7.5%. SEBI allows you to invest in 10% in AAA issuers. We invest only 7.5%. SEBI allows 8% for AA plus. We invest only 5%. So these type of constraints have been put in the system to ensure that the portfolio quality is maintained, highest quality, and we play we do a very disciplined way of managing the fund.
Great, great, great. So with that, we have come to an end to this interesting session. Thank you so much, Anju, for your insightful discussion and time.
Thank you very much. Thank you for the opportunity.
Okay. And finally, I thank each one of you for being such a wonderful audience. Have a great day, guys. Bye.